What's the difference between ETFs and mutual funds? Mutual funds and exchange-traded funds, or ETFs, are both based on the notion of pooled fund investment and follow a passive index strategy to monitor or replicate representative benchmark indices. They are comparable in some aspects, yet they're not the same in some ways. In today's video, we'll be talking about the key differences between ETFs and mutual funds. Before we get there, let's first have an overview of these two types of funds. Mutual funds are pools of money collected from several individuals in order to invest in stocks, bonds, and other securities. In other terms, a mutual fund is a collection of securities overseen by a fund manager and owned by a group of investors. When you buy a mutual fund, you're putting your money into a pool with other investors. A fund manager handles the money that you and other investors have pooled and invests in financial assets such as stocks, bonds, and other securities. Mutual funds are managed on a daily basis. Exchange-traded funds, or ETFs, on the other hand, are baskets of securities that you can purchase or sell on a stock market through a brokerage firm. ETFs are available in almost every asset class imaginable, from standard investments to so-called alternative assets such as commodities and currencies. Novel ETF structures also allow investors to short markets, obtain leverage, and avoid paying capital gain taxes on short-term gains. After a few false beginnings, ETFs boomed in 1993, with the product known by its ticker symbol SPY, or SPIDERS, being the most popular ETF in history. ETFs are expected to be worth $5.83 trillion in 2021, with almost 2,354 ETF products trading on U.S. stock exchanges. As of December 2020, the United States is the world's largest market for mutual funds and exchange-traded funds, or ETFs, accounting for 46.4% of total global assets of $63.1 trillion in regulated open-end funds. According to the investment company Institute, U.S. registered mutual funds had $23.9 trillion in assets as of December 2020, compared to $5.4 trillion for U.S. ETFs in the United States. There were 9,027 mutual funds and 2,296 exchange-traded funds at the end of 2020. Mutual funds and exchange-traded funds, or ETFs, are less risky than individual stocks and bonds and provide a wider range of investment possibilities. Professional portfolio managers control and oversee both in terms of management, while these two financial products are based on the same pooled fund concept and are subject to the same federal securities rules. Mutual funds and ETFs have very distinct differences that can be appealing depending on the investor. Active and passive management. The way a fund invests has a big impact on your fees and possible profits. Some funds use active management, in which the fund manager chooses which stock to buy and sell, as well as when to do so. This method is more common in mutual funds. The alternative method is known as passive investing, and it involves a fund manager who does not choose the investments but instead imitates an index that has already been chosen, such as the S&P 500. ETFs are more likely to use this approach, although they can also be actively managed. In general, mutual funds have been actively managed, whereas exchange-traded funds, or ETFs, have been passively managed. However, these distinctions have been blurred to the point where actively managed ETFs and passively managed mutual funds are now available. This distinction is significant for two reasons: the profits you'll likely receive as an investor and the expense ratio you'll likely pay. But before we continue, go ahead and click the subscribe and like buttons. It takes a lot to make these videos. Your small actions tell YouTube to keep promoting our videos. Also tell us in the comment section which type of fund you'd want to pursue. Thanks. Now back to the video. Returns on investment and costs. The bottom line in the active versus passive debate is that passive investment outperforms active investing most of the time. Indeed, according to recent research from S&P Dow Jones Indices, 90% of active managers at large companies in the United States were unable to outperform the market over a 20-year period ending December 31st, 2021. Yes, the greatest funds can outperform their benchmarks, typically the S&P 500, in a given year, but active managers struggle to really excel over time. The purpose of passive investing is not to beat the market, as is the case with active managers. Passive investors, on the other hand, simply want to be in the market, and if passive investing outperforms the great majority of investors, it follows that you can also win over the majority of active professional managers. ETFs, which are normally passively managed, benefit from this. Another disadvantage of active management is that it is more expensive than the passively managed fund. The introduction of low-cost ETFs has aided in the reduction of mutual fund charges. For the previous 2 decades, fund expense ratios have been declining. Whether you compare a simple average or an asset-weighted average, stock mutual funds still have higher expenses than ETFs. Minimum purchases and commissions. ETF investors are huge winners when it comes to commissions. Commissions on all ETFs provided on major brokerage sites have been lowered to zero. As a result, trading these funds will not cost you anything, though certain brokers may charge an early redemption fee. This is fantastic news for investors, particularly those who like to dollar cost average their purchases. However, this isn't the case with mutual funds, where some still impose sales commissions of 1 to 2% on your investment, and occasionally much more. Many solid mutual funds no longer impose these fees, and avoiding them is extremely simple. These fees should be avoided since they benefit the fund management firm at the expense of your returns. Also, brokerages may charge a fee for trading mutual funds, some as high as $50 a trade, while the best brokers offer many funds with no trading commission. ETFs generally offer an edge when it comes to a minimum purchase amount. Typically, a broker will require you to purchase at least 1 share of a fund in order to make a purchase, though many brokerages now enable functional shares to be purchased. Even if you had to purchase a full share, it might cost anything from $20 to $250, which is still a small sum. If you're starting your own individual account, some mutual funds, on the other hand, may need you to acquire at least $2,500 to get started, with reduced minimum subsequent payments. If you sell your mutual fund position in less than 30 days, you may be charged an early redemption fee. Apart from the differences mentioned above, how you choose between these 2 types of funds may depend on your personal needs. If you prefer small investment minimums, an ETF may be a better fit because you can buy 1 share of an ETF for the price of 1 share, also known as the ETF's market price. The price might be as low as $50 or as much as a few $100s depending on the ETF. The minimal initial investment in the mutual fund, on the other hand, is not determined by the fund's share price. Instead, there's a certain sum of money. A $3,000 minimum investment in most Vanguard mutual funds will get you 30 shares of a hypothetical fund with a net asset value or NAV of $100 per share. An ETF could be a good investment if you want more control over the pricing of your deal. ETFs not only provide real-time pricing, but they also allow you to employ more advanced order types that provide you the most price control. It's fine if you want to keep things simple. You can simply place a market order and it will bring you the greatest current pricing without the hassle. In the case of mutual funds, you'll get the same price as everyone else who bought and sold that day, regardless of when you place your order, since the price isn't determined until the end of the trading day.